Group expert joins us on the phone line. Ben, good morning. Wish you a very happy 2016. One hopes it doesn't pan out for the stock markets the way it is doing on the first trading day. But give us your thoughts on the Chinese PMI number for December. Is it indicating fresh weakness?
Well, I think it's a sort of a symptom of the continuing weakness we've had in the market. I think the reality is when you look at the manufacturing here is that we have an oversupply that really needs to be unwound. There isn't a tremendous amount of demand coming out of emerging markets right now with the rate hawks sort of wreaking havoc with various countries' currencies. I'm not that worried about the overall economy here. I'm not that worried about China's stock market for the rest of the year, mainly because in large part it's policy-driven. But I do think we're going to see continued weakness with the PMI maybe over the next couple of months.
Okay. Expect continued weakness in the PMI over the next couple of months. So what are you factoring in? Currently, the Caxton PMI data has come in at 48.2, and it's been the 10th straight month of contraction. Say in the next couple of months, how much lower do you think it could go?
Well, I think we're probably going to see it get to a point where it's maybe sort of hitting even. I'm hoping that we see 49 or 50 next couple of months so that we're at least stabilizing in the market. I think a lot of people were hoping that we were going to be, closer to 49 this month, and obviously we came in under that. There aren't a lot of signs that demand here is picking up that much right now. So I do expect it to continue to go weaker. The government's not going to like this. They don't like seeing contracts 3 months in a row because that sort of sends very negative signals. But I think they're holding the course here. They want to see a real reform in the economy, and so that's why I think we're going to continue seeing it to contract, because they're not going to be pushing industrial production that heavily.
Over the weekend, we heard, reports about an expectation of a reserve ratio cut. Do you expect the government to go into some kind of an overdrive with either fiscal and or monetary steps?
Well, I do think probably throughout the first half of this year, if they don't see greater pickups happening, they're going to be trying to get more money out into the economy. They're going to try to make it easier for small businesses to borrow. They're going to try and get consumers to actually be willing to put their money in the banks. So I think we're going to probably see more reserve ratio cuts, maybe opening up the band for bank interest rates a little bit more. I don't think they're going to do anything drastic, but I do think they'll probably take measured steps going forward to try and stabilize the market and sort of increase demand. I think one thing we've seen is I think they're going to be a little bit firmer about how much they let the RMB trade. I think we're going to have it sort of stick around 6.5 for a while, just so that they feel like they're putting stability back into the market.
All right, Ben, we'll leave it at that. Thanks so much for joining us. So worries continue over the Chinese market.